going to be talking today about three areas that are near and dear to my heart, including real estate, stocks, movies. Basically, the bottom line is, I'll give the game away right now, cheap is beautiful. The less you pay for something, the lower is your risk, and the greater your subsequent return on investment is going to be. I'm not offering any specific investment advice or offering any specific buy or sell decisions. And the investments that I do mention today are for illustrative or educational or entertainment purposes only. You need to seek the advice of a qualified, conflict of interest free financial advisor who can look to your circumstances and guide you accordingly. Next time, we're going to be talking a little bit about the devastating impact of overpaying for assets and the math around that. So I hope you enjoy the pieces on movies, real estate, and stocks. And as usual, if you have any questions, please leave them in the comments below. It turns out that one of the cardinal rules of investing, namely that the more you pay for something, the lower your subsequent returns are going to be, holds true for the movie business as well. The movie industry is a really tough one. Apparently 7 out of 10 movies fail at the box office, which means they don't even make back in box office what it costs to make them in the first place. You look at the greatest return on investment movies in Hollywood history, and they all have one thing in common. They were relatively inexpensive. So things like Paranormal Activity, Devil Inside, Black Swan, the list of relatively inexpensive Hollywood movies that were great successes goes on and on. Obviously, cheapness doesn't guarantee success because of that 70% failure rate. Pontypool, I'm looking in your direction. But cheaper is generally better when it comes to investing in the movie industry. The opposite also holds true. If you look at the biggest catastrophes in Hollywood history, Mars Needs Moms, John Carter, Jack the Giant Slayer, they all have one thing in common as well, and that is they had huge budgets. Now, when you have a failure rate of 70%, putting up a huge budget is incredibly risky. I think the lesson that Hollywood executives should take from that data is that they should finance a larger number of inexpensive projects. Now, obviously, there have been some mega projects like Avatar, for example, that have made fantastic returns on investment, or fantastic real dollar returns, rather. I think Avatar cost a little over $500 million to make, and it returned $1.7 billion. And that's great, but on a return on investment basis, they risked a lot of money to get that, and they only tripled their money. I mean, tripling your money sounds actually quite good, but when you compare that to, say, the return on investment from Paranormal Activity or Black Swan, the percentages just don't compare. In Hollywood's case, it's a better idea to risk as little as possible for as much of a return as possible. Okay, on to real estate. As I've said in other videos about real estate before, when it comes to looking at Canadian real estate, I don't think it's reasonable to accept the opinion of Canadian banks. The mortgage business represents such a huge percentage of their revenues and their earnings. They're not going to talk down the golden goose. Pay as little as possible attention to what the banks have to say, and focus on the following ideas, as I've mentioned in a few videos in the past. Look at the median income in your city. In Toronto right now, it happens to be about $70,000, and historically, there is a relationship between the median income and the value of the average house. There has to be a certain number of people in the market who can afford a certain house at any given time. And if house prices are way out of reach for most people in the city, those prices have to come down. Another thing to look at, of course, is the demographics. Are people moving into the city? Are people forming households? And are people having children? People tend to seek out neighborhoods that have good schools. And I think a lot of the real estate bears don't focus as much on demographics as they should. Another thing to look at, as I've mentioned in the past with real estate, is that you want to focus on the recent price performance of the real estate has done compared to the underlying economy in your city. If real estate prices have risen 10-15% a year for the last 10 years, and the economy, the real economy, the non-speculative economy, has sort of gone flat to slightly down, at some point those two lines have to reconverge. That might be another sign that what you're sitting on is an overpriced asset. Another thing to look at when it comes to real estate, of course, is comparing the all-in costs of rent to the all-in costs of ownership. And when I say the all-in cost of ownership, I mean renovations, property taxes. There's a principle in economics, they call it a law in economics, it's not really a law, but called the law of one price. A similar good should over time equaled out to the same price. Rent in Canada in aggregate right now violates the law of one price. That's another reason why real estate prices are a little overvalued. Okay, when it comes to stock investing, just like movies and real estate, cheap is beautiful. There's lots of evidence to back up the claim that cheap is beautiful when it comes to stock investing. And for the sake of brevity, I'm only going to pick on two examples. The first thing I'm going to talk about is the performance of national stock markets in 2013 as represented by their exchange-traded funds. And then the next thing I'm going to do is look at John Hussman's great work. And so let's focus on the ETFs first. If you look at the cheapest 5 markets going into 2013, they were in order, I think, Greece, Ireland, Argentina, Russia, and Italy. Those were the 5 most inexpensive markets on a cyclically adjusted price earnings multiple basis going into 2013. And the most expensive were Peru, Colombia, Indonesia, Mexico, and Chile. Those were the most expensive markets going into 2013. Now, when we look at the performance of the cheapest versus the most expensive, well, the obvious happens. The cheap do really, really well on average, and the most expensive do really, really poorly on average. Now, this is obviously only 1 year of data, but the relationship holds throughout multiple time periods. The idea is when it comes to stock investing, you want to buy cheap. Now, how can you do that? How can you find things that are cheap when it comes to stocks or ETFs? You have to be able to see potential that most other people don't see. And that's a very challenging thing, and it's an emotionally painful thing to buy the national stock market of a place like Greece or Ireland. Think about it. In 2013, if you said to someone on January 1st, 2013, I'm going to put assets in the national stock markets of Greece, Ireland, Italy. I mean, these are members of the pigs, for God's sake. I mean, when you think Greece, you think riots in the streets, you think no one pays taxes, you think people throwing Molotov cocktails around. When you think Ireland, you think massive debt that the state has been forced to take on, or taxpayers have been forced to take on to bail out some banks, which is ridiculously corrupt in my opinion. There's lots of reasons to avoid these things. In order to succeed as a stock investor, you need to be willing to do things that would cause your friends to tell you that you're at least eccentric to buy these things. And so again, that's why stock investing may not be for everyone. Now let's look at the relationship over time between the stock market and its level of expensiveness or cheapness. We're going to do that by looking at one of the graphs generously provided by John Hussman in his weekly market commentary. If you're interested in stock investing, I highly recommend his weekly letter. Okay, so this graph has 2 lines. The first thing to notice is that they follow each other pretty closely over the decades. They don't deviate very far from each other. Now the blue line represents how expensive the American stock market, the S&P 500, is on a price to revenue basis. The red line represents the subsequent returns at each point along that blue line of what the next 10 years returns are going to be. What we find is that the more expensive the market gets, the lower the subsequent returns are going to be. This graph really beautifully encapsulates that idea. Now, obviously, there's much more to investing in stocks than simply to buy cheap. There's tomes written on it, but I wanted to offer up this introductory piece to get you thinking about the need to focus first and foremost on inexpensive, because history has shown that those people who are willing and able to buy stocks that are inexpensive do relatively well, and those people who get suckered into narratives or get, who buy into a story stock, they do really, really badly over time. Cheap is beautiful when it comes to stock investing, real estate, and movies, as it turns out, and probably many other domains. Thank you very much again for watching. That about does her. Wraps are all up. Take care.